So glad you're here today with us on the College Investor Audio Show as we take a look at how you can shrink your student loan payment under the income-driven repayment plan. No joke. Let's do this thing. But first up, I just want to remind you to go ahead and hit that subscribe button. You can share this podcast with anybody you think it would be helpful to, and we greatly appreciate that. Plus, you're always going to be up to date when we post new content, and we do that like all the time. You can also like us, follow us on social media, ask questions, get to know us. We'd love to help you along in your journey. Just search for The College Investor and you'll find us. Okay, so here's how to shrink your student loan payment under IDR. So the income-driven repayment, or IDR plans, as you know, provide affordable monthly student loan payments just by basing the payments on a portion of the borrower's discretionary income, as opposed to just basing it on the amount they owe. Generally, IDR plans will yield lower student loan payments when the borrower's total student loan payment exceeds their annual income. However, there are ways to actually decrease the payments even more. Discretionary income, by the way, is calculated by subtracting a multiple of the poverty line from adjusted gross income, or AGI. Discretionary income may be reduced by reducing AGI or by increasing the applicable poverty line. Avoid fraudulent tactics like underreporting income or falsely inflating family size. Just don't do it. These carry severe penalties. Let's take a look at how to legally reduce AGI. Yeah, reducing your AGI directly translates to lowering your discretionary income, which then lowers your IDR payments. Several legitimate strategies can help achieve this. One of them is maximizing your retirement plan contributions. Retirement plan contributions are a type of above-the-line exclusion from your income, which are subtracted from income before calculating AGI. So contributing the maximum amount you can into a tax-advantaged retirement plan lowers your taxable income. For 2025, this includes up to $23,500 in contributions to 401k, 403b, or government 457b plans, up to $7,000 in deductible traditional IRA contributions. Employer contributions also actually don't count toward AGI, so you should go ahead and maximize the employer matches that you have on your retirement plan contributions. Some employers will base the employer match on student loan payments as an alternative to employee retirement plan contributions. Another pretty cool thing. Also, avoid unnecessary retirement plan withdrawals. Distributions are going to increase your AGI, and health savings account contributions of up to $4,300 will reduce AGI. Defer income strategically. Delaying bonuses or other forms of income can temporarily lower your AGI in a specific tax year. However, it may be better to have more uniform income without significant annual fluctuations. You can also claim the student loan interest deduction. You can deduct up to $2,500 in interest paid on federal and private student loans, directly reducing your AGI. Note, though, that this deduction is not available to married borrowers filing separately and is based on actual interest paid, not waived amounts. This is important. Employer-paid student loan repayment assistance programs, or LRAPs, might even reduce or eliminate your eligibility for this deduction. Just keep that in mind. Tax-free employer LRAPs are available through the end of 2025, but are likely to be extended or made permanent. We'll see. You can utilize other above-the-line deductions too, such as self-employed individuals and small business owners like me can deduct legitimate business expenses. While not applicable for those pursuing public service loan forgiveness, PSLF, substituting stock options for a part of your pay can actually defer income recognition until the options are exercised. Claiming a capital loss of up to $3,000 can offset income. A $3,000 decrease in AGI can reduce your monthly student loan payment by $25 a month or more under an income-driven repayment plan. Pretty cool. The penalty for early withdrawal of savings from a CD, certificate of deposit, is deductible. Eligible educators can deduct certain expenses as well. Let's talk about married borrowers and how you can file separate tax returns. Married borrowers can file their federal income taxes separately to have only their own income counted when calculating the monthly loan payments under an IDR. Their spouse's income is completely excluded, although the spouse may still be counted in household size. However, married taxpayers who file separate returns do lose valuable tax breaks, like the student loan interest deduction and even the higher standard deduction. Here's how to increase the poverty line. Let's talk about that. So IDR plans factor in household size by subtracting a multiple of the poverty line from income when calculating the monthly student loan payment. Therefore, a larger household size leads to a lower discretionary income and thus a reduced loan payment. The poverty line varies based on the borrower's location in the U.S., Alaska, or Hawaii, and family size too. In 2025, each additional family member increases the poverty line by approximately $5,500 in the continental U.S., with higher amounts for Alaska and Hawaii. Consequently, each additional family member can decrease the monthly student loan payment by about, $45 or more. Pretty cool. Borrowers should ensure that their reported family size accurately reflects the number of dependents claimed on their federal income tax return. Yeah, you can update this if your family size increases after the end of the tax year. It just must align with subsequent tax filings. Don't engage in fraud. Ever. But here too, some borrowers might be underreporting families or overreporting family size when applying for an income-driven repayment plan to reduce their payment. This is called fraud. Beware, because some document preparation scams will inflate family size in order to lower the student loan payment. The U.S. Government Accountability Office, GAO, has reported instances of borrowers providing inaccurate information, including claiming an implausibly large number of dependents or zero income when wage data indicated otherwise. Okay, don't do this. My goodness. The GAO actually said tens of thousands of borrowers might have provided false information when requesting an IDR. In 2016 and 2017 alone, more than 35,000 borrowers claimed to have a family size of 9 or more. 1,200 borrowers claimed a family size of 16. What? Dudes, don't do it, including 2 borrowers who claimed a family size of 93. You got 93 dependents. That makes sense. A third of borrowers who reported zero income actually had wages high enough to require a non-zero monthly student loan payment. The overall fraud rate may be as high as 3% based on the GAO data. And they will come after you. These activities carry severe consequences. Under the Higher Education Act, you could face fines up to $20,000 and be in prison for up to 5 years, in addition to being required to pay restitution. Furthermore, you may be subject to penalties under mail and wire fraud statutes, which include significantly longer prison sentences and much higher fines. Don't do it. Bottom line, never. Just never do this. The Department of Education cross-references the information provided on your IDR with your current and subsequent federal income tax returns and other federal income databases. They will find out. Other ways of saving on student loans. You can enroll in autopay. Super simple, and the federal government offers a 0.25% interest rate reduction if you do that. I did. Reduce my payments. While this directly reduces the total interest paid over the life of the loan, its impact on the monthly payment under an IDR is less significant. The loan payments under an IDR plan are based on the borrower's income, not the amount owed. Just keep those things in mind. And that is our show for today. I hope it was helpful to you and maybe some friends of yours. If you have anybody who would benefit from this podcast, please feel free to share this with them. We would appreciate that greatly. Also, hit subscribe, like us, follow us on social media. We're pretty much anywhere you are. Search for The College Investor and you'll find us. And check out our website, the one-stop shop for everything you ever hear on our podcast and so much more at thecollegeinvestor.com. Thanks so much for stopping by today, and we will talk to you again real soon.